The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome, and great Monday morning. This is the kind of episode that I kind of like, and it challenges you, the listener, to submit questions, and then it challenges me to be able to answer those questions. Hey, this is a test of tax knowledge. So if you've got questions, wherever you're listening, go to the comment section, go ahead and put your questions in, hit send, like, share, the whole works. Let's get the word out that we're here talking taxes, and we're talking taxes for you. Whether it's individual taxes, whether it's small business taxes, whether it's trucking taxes and trucker bookkeeping, you name it. Hey, I've got a bunch of new clients, and I would like to sit here and name them all over at Trucker Tax Tool. Some great truckers that have come to us over the last week, including Amanda, Robert, David, Daniel, Greg. I know I'm missing about 10 more just off the top of my head, but those are meetings I have coming up here in the next few hours with them to do their initial call and get them all set up in the bookkeeping and the tax department to make sure we're dotting the I's and crossing the T's. Hey, today, like I said, we're going to be taking questions. You got questions? Submit them. We'll get them answered. I'm talking first here in this first section about tax planning and how important planning can be in your business and personal when it comes to taxes. See, some people think, hey, I'm going to show up, in February, March, April, and I am going to be able to save the most amount of money on taxes because I've gone to somebody to prepare my taxes. We're limited in what we can do after the year is done. And that means most of the deductions and everything that you've spent money on can be deducted. Let's say we're working 2025 and we're getting ready to do your taxes. If you haven't spent the money, used the money to find the deductions in 2025, we're going to be very limited. Yes, we might be able to do some retirement accounts. Yes, you might still be able to contribute to your health savings account if you have a qualified medical plan. But being able to strategize with you what you can do throughout the year to maximize deductions, it makes it very difficult. Buying a new vehicle or new tractor or new piece of equipment for your business can't happen in 2026 and deduct it in 2025. But if this is a needed piece of equipment, and we don't make this recommendation strong, without looking at what's going on in your business. So this isn't one of these strong recommendations everybody should run out and buy a piece of equipment because I'm going to be able to take depreciation and lower my taxes. But if you didn't need the equipment, it doesn't improve your bottom line, doesn't improve the way you do business, then you're just spending money. So you run out and buy a new truck or new tractor, new trailer, new piece of equipment, and it costs you $100,000. yeah, it could save you, you know, 10, 15, 25, 30, $40,000, depending on what tax bracket you're in. And, you know, self-employment taxes and the whole works it could be there, but you're still out the other $60,000. So it may not be the wise financial decision. It may be the tax decision that you need to make, but it doesn't make the decision right. So you got to put some business sense to everything you do, even when you're talking about saving taxes, because, you know, yes, our goal here is to minimize the tax you pay, maximize the profit that you're making. And you've got to use the scales and the values of what is going to make sense for you. You know, some of the things we see in tax planning is people rushing out because they hear S Corp. And S Corp can save you money. A rush decision in jumping out to S Corp can cost you thousands instead of saving you thousands. Now, when they talk about tax savings, when they're using an S Corp, they're talking about saving money on self-employment tax. And that, oh my God, your tax bill is going to drop overnight. But what many people don't realize when you're making this S Corp election is that you're going to have additional costs. And an S Corp election is only really works consistently if you are consistently making a profit, but then you're also ready to handle the administrative nightmare that comes with it. So you're going to have increased costs for payroll compliance. So you've got to do payroll. You've got to file the tax forms, 940, 941, W-2s, W-3. You've got to pay the payroll taxes. So you're going to pay in the federal withholding that you withhold from everybody's paycheck, Social Security, Medicare, and the match of Social Security, Medicare. And then you're probably going to have federal unemployment taxes to that, state unemployment taxes to that. And then you get down to your now, hopefully, savings. Then you're going to have an additional federal filing with a 1120S. That is your corporate S Corp return. And then the K1s that go along with it. Then, I know this sounds bad, you'll have an additional scrutiny of your business for having a reasonable salary for the owner that is working in the business. Now, you could also cause yourself a problem because you could potentially overpay yourself if you're not profitable enough. So we in tax planning will weigh out the difference between being self-employed or being a single member LLC, both reporting on Schedule C, versus what your tax liability would be reporting as an S Corp, and then decide, hey, which is the best route for you to go and the best way for your business, and whether your business net income is going to support being an S Corp and the model of the S Corp, and will it continually do that year after year. So, you know, you got to make sure that you're doing this, you're timely filing for that S Corp election and making the right choices. So we sit down and analyze your last 12 to 18 months of your business. We also sit down with you and forecast the next 12 months so that your S Corp timing can be done correctly. And David, thanks for the question out here. And man, we're getting started with questions. So it's really nice and it's great. Should I have a separate checking account for business and personal? And we tell you absolutely. So one of the first things we do, whether you're a sole proprietor, whether you're a single member LLC, multi-member LLC, whether you set up an Inc. So if you're XYZ Inc., XYZ Trucking Inc., first thing we're going to ask you on the phone is about your checking account. And we're then going to ask you about, do you mix business and personal in your checking accounts? You know, we know life moves absolutely quick. You grab your business card, you go out for lunch, and you forgot it wasn't a client meeting, or you cover a expense that should have been on your business card and you put it on your personal card. You know, life happens. You can get reimbursed for that. But you can't transfer the transaction. But to the, you know, for the IRS, it could be a red flag. Also, when you are commingling funds, if you are set up to limit your liability, that commingling funds can pierce what the attorneys tell me is corporate veil. Now, I'm not an attorney, never wanted to be an attorney, don't charge legal fees. So don't take this as legal advice. Take this as tax advice. So when we come back from this break, we're going to continue talking about some of the risks that you have commingling funds, business and personal, in your company. We'll be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
And we're talking about taxes, tax planning, and all your questions. So get as many questions in regarding taxes as possible. Misty, when did they separate C and S Corp? You've actually got to make this election yourself or through us to establish an actual S Corp. So when you set up your corporation with the state, so if you do Misty Trucking Inc., and then file for your employer identification number with the federal government, it's going to come back and tell you you're going to file an 1120, which is a C corporation. And if when you are a corporation, then you have to file that 1120 every year unless you make the election through the IRS to make yourself an S Corp. And you only have so much time to do it, otherwise you've got to jump through some hoops and do it retroactively. So you want to make sure you file the 2553 timely to make that S Corp election. Now, when you are a company like this, an LLC or a corporation, and you start commingling funds, mixing business and personal, you can lose some deductions out there and the eligibility of some deductions. Of course, the attorneys tell me you're going to weaken your legal protections, piercing that corporate veil for your LLC and your corporation. You could get, if you were going through an IRS audit, you might have some penalties, not necessarily from commingling funds, but for making something that's non-deductible and stuff out there. And then you could have some very difficulty producing clean and credible books for your investors. So you want to make sure that you're doing that. If you did charge something, I saw a question flash up. I didn't see who it was. It was from Mickey. If you do use your personal card for business, can the expenses be repaid to the personal? Yes, what I tell people to do is to make it clean, file an expense report with your company. Treat it like you're working for somebody else. And file that expense report and get that reimbursement. Put the receipt in there, attach it to it. It's the same like turning in, let's say, mileage. You're using your personal vehicle for business. Do the expense report and turn that in so that you can track every month your mileage, and you have where you went, places you were going, and the reimbursement to yourself for that mileage. Let's see. I've got a message here from Gary. Am I required to make estimated tax payments as a small business owner? Yes, no, maybe. First thing we're going to do is look at your 2024 tax return. What was your tax liability from that return? Not what you had to pay when you did it, but how much money was the actual taxes. Then we have to look at what is going to be your federal withholding for this year. If, let's say, your spouse works and has a W-2 income and you've been in the business before, and at the end of the day, her withholding is enough to cover what the tax liability was on your 24 tax return, then the IRS is not going to have a requirement for you to make an estimated tax payment. But you may be required to pay taxes April 15th of next year, and you probably got to do a little bit of tax planning to see if you need to set money aside to pay future taxes next year. Not necessarily have to pay them in. So maybe your income has increased greatly, or maybe your spouse lost their job and doesn't have the W-2 income. Then you probably would have to pay estimated taxes because you don't have that withholding anymore. So there's a lot of variables to it. So that's why it's yes, no, and maybe. If you're seeing a huge increase in net income, then you definitely want to go through some tax planning and set enough money aside. Now, maybe you've made money in business and this year is a really down year and you're having to pay exorbitant estimated taxes. You can actually go to the actual method and pay your estimated taxes based on actual earnings from your company. Now, that requires a very close review of your financials and your financial situation prior to each estimate being due. Now, when are those estimates due? First one, April 15th. Nothing like hitting you square in the head when you're already having to pay taxes or file by April 15th. Then you got to make your first estimated tax payment. And then the next one isn't a quarter later, it's 2 months later, and it's June 15th, and then September 15th, and then January 15th. So you've got those 4 tax payments that are out there. We're just glad they didn't hit you December 15th right before Christmas so you can enjoy your holidays and spend some money out there. But even if you don't pay estimated taxes, and you're not required to, make sure you're looking at your financial position and where you're at, so that you've got enough money to pay the taxes, plus possibly the first estimate come April 15th, because that's a double witching hour. You want to make sure you got money for both of them and get those things both paid when that's out there. Hey, when we do tax planning, we're always looking at what we say is minimizing the tax, but maximizing profit, and sometimes, that goes hand in hand. Sometimes it sounds contradictory. Hey, how am I going to maximize my profit? The more we can minimize the tax that you're due, the more money you actually keep in your pocket. And one way we do that is making sure that you're tracking all deductible expenses. Are you finding everything that can be deductible? See, when I go and I do a seminar with OOIDA, Owner Operator Independent Drivers Association, and I go there and I speak, and I also write for Landline magazine. You can see my articles in there, Trucking and Taxes. In fact, I was working on an article this morning and talking about different expenses that are missed and different tax problems that people have. But what we always look to do is to make sure that anything that you're paying with after-tax dollars that should be business related, meaning you didn't find it to take it as a deduction, we find it to make it deductible to save you money. Now, that minimizes profit, but also maximizes what you're keeping, because it's moved it from where you're paying an extra 20% on it because of your tax bracket, or 30% with self-employment taxes and everything into it. So you're paying this with after-tax money, and it should be paid out of this bucket over here that is before tax. So you got to make sure that you're tracking your deductible expenses, and making sure that even the small purchases like subscriptions, parking, client gifts aren't slipping through the cracks, and that you're getting all of those deductions. Sometimes the big things are easy: fuel, rent, marketing. But if you're not logging every single expense, then you're giving the IRS a much bigger check than they deserve. Not that they deserve anything, but we do have to fund the federal government for our protection, Social Security, Medicare, yada yada yada, you name it, we do it. So you need to make sure that you're tracking all your expenses, so you're not losing deductions, overstating profits, or you missing the opportunity for legitimate write-offs. Now, you kind of got to make sure that you're dotting your I's, you're crossing your T's, making sure the deductible expenses is the correct expenses out there. You may be paying cell phone, and you think it's 100% write-off. Well, that cell phone that you have out there should be allocated to both business and personal, especially if it's your personal line. Because you do take phone calls from your mom, your dad, your sister, your brother, your friends. But you're also taking phone calls, your business associates, your clients, people that work for you, or people that you work for, whatever it is, that you've got to be able to take the appropriate amount of the write-off. So you got to be aware of these things. You don't want to overstate the deductions, but you don't want to miss the deductions either. So, make sure that you have what you need and you're getting the proper deductions that you need to have for your business. Hey, we're going to talk some more and answer some more questions right after this quick break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Like I said, I love questions. Last week we had a great show. We had a lot of questions, and I got a lot of comments over my dogs. Maybe next week I'm going to do it out by the chickens or something, so we can see how many people we have that love chickens or have backyard chickens. I could do a whole show just on backyard chickens and what we've learned. But we talk about taxes, truckers, bookkeeping, small businesses, your personal taxes, you name it. Hey, I got a great question from Gabe. Can I get another extension? I figured out I'm going to owe more money than I thought, and I need more time to pay and file. Gabe, unfortunately, the IRS gives you a 6-month extension if you filed for the extension before April 15th, and then you would have to file it by October 15th. The extensions that IRS grants you is not an extension of time to pay, only extension of time to file, and they only give you those 6 months. So if you're owing money, you should have paid it all in by April 15th. Otherwise, the IRS is going to hit you with interest and penalties. And, unfortunately, there's not another extension to file to get you more time to file. On top of that, you just need to do everything you can to get it filed. And then, we can work with the IRS to set up a payment plan. If the amount is significant and your income has gone down and you can't afford to pay, then there's other solutions that are there for you that can be put in place. But they're also going to require that you actually pay your estimated taxes as well with any solution that's going to go in. So if your income is down, then I suggest you go to the actual method to do your estimated taxes and prove that you can pay a lower amount than what would be based on the 2024 tax return that you will be filing, hopefully by the final due date in October 15th. Now, if you were a partnership, S Corp, that 6-month extension went from March, and therefore you have till September 15th to file your S Corp returns and stuff out there. Rebecca, can I file my taxes for free? IRS says you can. You can go in and free filing may be possible using IRS direct file or IRS free file, depending on your income and your tax situation. Other options are, there's places all around the country called VITA, Volunteer Income Tax Assistance, or TCE, which is Tax Counseling for the Elderly, can also be explored if you are qualified. So either program you may qualify for, yes, you can do it. Do I absolutely suggest it? I've seen some of these things prepared. No, not necessarily. But if that is your only option, and you can get away with free file, that's fine. If you're straight, just one W-2 and maybe you're young, hey, maybe you can get in and use IRS direct file depending on what your income is as well. Brenda, what if you miss the tax filing deadline? Well, if you miss the deadline and taxes are owed, hey, penalties and interest are going to accrue. However, if you got a refund coming back, there's generally no problem with filing late, but file as soon as possible. Now, I'm going to tell you, I've seen people who didn't file. They were afraid they were going to owe or just didn't get around to it. And, you wait, you drag your feet, and now you're 4 years, 5 years down the road, and you're going to go file, and you find out you're going to get a refund from a tax return from 2019 or 2020 or 2021. And guess what? You're not getting it. You had 3 years to claim for a refund. Now, isn't it ironic? The IRS can go back as far as it wants to force you to file and then collect the tax for 10 years after you filed and it's been accepted. But you've got only a 3-year period to file your tax return and do a claim for refund? Some things are left to make you wonder, isn't it? Gabe, follow-up question. How can I make my estimated tax payments? You can go online, go to irs.gov and do your estimated tax payments there. Make sure when you put in your estimated tax payments, you log in to your own account out there and make sure it's verified. They use OneID or something else out there for this. And you can make your estimated tax payments now. Make sure you put in the tax year 2025 and the estimate tax payments. Because if you don't, you happen to put 24 or some other year, that's where it's going to go. And then you would have to call the IRS to get them to move the money. But if you owed them, they're not going to be very happy about moving the money to estimated tax payments. That's out there. But that's the easiest way. You can also send in a check and use 1040 ES and send that form in with a check, and the IRS will still accept it. Again, make sure not only on the ES form, when you're sending it in, on the check, put your social security number, put 2025, 1040, first quarter, second quarter, whichever quarter it happens to be. So that you can make sure it gets credited to the right period. And if it doesn't get credited to the right period, then you have proof that it should have went there, and the IRS would have to move those dollars to the right estimated tax payments. All right, Brenda, man, we're on a roll here. One big, beautiful bill. What's in it? Well, right now it is passed the Senate with some changes. It goes back to the House, and I believe it's going into committee, and they will settle all this out. And at the end of the day, once the dust settles, we'll be able to go through and do a complete review of what the tax implications is in this bill. There are some really nice things I have seen. Now, once they finish going through the numbers out there and reconciling between the two different bills, the House and the Senate, and it gets to the president, you're going to see some increases in child tax credits. You're going to see where cash tips have become non-taxable as long as your income is below a certain amount. It might be interesting to change the way people get paid and, start taking cash tips even in service business that isn't where you're doing waiter or waitresses. I mean, maybe I should just do a line item that, hey, send cash to our staff for tips and make it non-deductible or non-taxable. I've also seen where they're going to make, and I don't know all the requirements behind it yet, Social Security non-taxable, but there's still going to be some things that I think if you're making too much money, you're still going to have to pay back or have your benefits reduced. Some of the other things that are happening, and this isn't necessarily from the bill, but 2025 standard deduction amounts for single filer is going to be $15,000. If you're married filing jointly, $30,000, and head of household, $22,500. The child tax credit for dependents under 17 right now sits at a maximum of $2,000 per child in 2025. So we'll see. Misty, is that tip thing really going to work? Yes, no, maybe. You know, it's one of those things that you might want to ask people how much of cash tips they're actually reporting to their employer and how much cash tips are actually given these days. Most tips are done on the credit card. So they're talking about cash tips. So unless something changed in that big, beautiful bill, might be limited in what actually is non-taxable. Or you and I, when we're out at the restaurants giving a tip, should start giving cash tips instead of putting it on the credit card form, because then they would not report it. So when I'm looking at that bill, I see the word cash tips, so I'm assuming it means cold hard cash. Now maybe the interpretation might be something different out there, but we'll have to look and see what happens with this big, beautiful bill. Hey, we got a couple other questions about capital gains and taxes, and we're going to talk about that right after this quick break.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Hey, this is a great question from Marty. Marty, you asked about what do we do different at Trucker Tax Tools than anybody else for trucker bookkeeping. You know, this is one of these things I can jump off and be on my soapbox about different people that jump into bookkeeping or taxes. And, you know, when you specialize like we do around truckers, we know all the deductions that you can take and look for additional deductions everywhere we can find it. Now, I see all the time online advertisements for people to jump out and be a bookkeeper, and that you can make hundreds of dollars off of people doing bookkeeping monthly. You know, those people, no training, not qualified. They just learned from some guy that gave a short, maybe a week course, 2-day course or whatever, and say, hey, this is what you can do. And then you're using your favorite software like QuickBooks or Xero, and think you're doing great, just itemizing what's on a bank statement. But you don't realize that in the trucking industry, you know, you need to track per diems. You need to make sure that you have the deduction for a lumper out there, or your scales, or your tolls, um, or maybe breaking down the way you get paid between fuel surcharge, gross trucking income. All those little things can make a difference when you, as a trucker, need to know, hey, where's my money coming from? How much am I making? What's my income? Or when I need to sit down and figure out my cost per mile, both the variable and fixed side of this. These are the things that become, really, really important when you're running a small business and you're an over-the-road truck driver. You don't have time to deal with all this and make sure your bookkeeper knows about the trucking industry. And using Trucker Tax Tools, go to truckertaxtools.com. We are here to cater to you and make the systems work for you. I was talking to a young lady who is in the trucking business, and she honestly said, hey, I've been doing this by the seat of my pants for the last couple of years, and I've come to you, and we turned everything over, and you've made this thing really seamless and easy. I was talking to a gentleman just on Friday who's a trucker out there. He's been in the trucking business for the last 4 or 5 years, been using somebody else, and they went, well, I'm not sure that they've gotten me all my deductions. And I told him, hey, I would do a 3-year review of his past 3 years tax returns. First thing we saw in there, they didn't take the deduction for per diems. There were other expenses in his business, and knowing what he does and the people that he uses, and he's moving furniture and stuff across the country, so he's hiring these kids, but there was never ever a deduction for contract labor, for helpers that are out there, or for a lumper. And it sometimes amazes me. And he goes, well, I didn't realize they didn't know what I was doing and didn't know the business. Well, you've got to know what you're doing, and you got to know the business. And so we take our time to go through everybody's books to make sure that, hey, what kind of business are you running? What do you do? What do you haul? Where do you haul to? Are you paying your 2290 taxes? Are you, paying your IFTA taxes? Is it coming out of your settlement statement? Are you getting every deduction? Are they deducting too much money for escrow? All these things become important and add up for you in your business, and how that it's got to make sense. So, when you're going through and doing this and finding somebody that knows over-the-road trucking businesses, truckertaxtools.com is the place to go. Give us a call at 877-996-2477. Again, 877-996-2477, or just go to truckertaxtools.com. Hey, right before that last break, I had a question from Emmanuel about capital gains. He was asking, what are the long-term capital gains rates for 2025? Sold some assets. Okay, so long-term capital gains for 2025 can be anywhere from 0% to 15 or even 20, depending on your taxable income and your filing status. Now, remember, these type of capital gains rates, depending on if you're selling an asset that you've depreciated, you may have to recapture depreciation, and some of that could be taxed as ordinary income for your business as well. Now, you also got to remember that depending on how long you've held the asset for, if it's been less than a year, you might be subject to short-term capital gains. And short-term capital gains are taxed as ordinary income according to where you fall on your bracket. So you do have, multiple rates for long-term capital gains, and then then you would have short-term capital gains if you held the asset for less than a year. This also goes for stocks, bonds, things like that you've held for a period of time out there. Let's see. Jeffrey, how do you file an amended tax return? Well, if you discovered an error on your tax return or something maybe you left off, or maybe the IRS sent you one of these nice courtesy letters saying, you left off stocks, bonds, and stuff, and they're not calculating it correctly, you would actually file a 1040X. That's your amended tax return for your individual. Now, if you're filing an amended return on a partnership or S Corp, you're just going to hit the box on the 1065 for partnership or 1120S amended return and send it in. It will also show an amended return on your K1s. It'll say amended. So don't forget, you amend the corporate or partnership return, you got to turn around and amend your personal returns as well. I think I saw another question come up. If we tip cash, can we deduct it? Yes, you can. So if you're running a business and you do tip cash, I would recommend that you again file an expense report with your company. So when you turn in the receipts that you charge maybe on your company credit card or debit card, and then you tipped cash, you'd want to get reimbursed. You can do it like a petty cash account, and then you would turn in that receipt with it that says I tipped cash $8 or $10 or whatever. If you're going to tip an extravagant amount of money, I've seen some people where they've tipped somebody, the full bill, put it on the credit card. That way you have tracking on it, because it's about your business deduction, not about necessarily their tip deduction at that point. But yes, you could do it that way and run it through kind of petty cash out there. It requires a little more paperwork and tracking. So is it worth it to you or not? A whole different story. Maybe I wouldn't necessarily do it when I'm doing it as a business meal as much as I would do it as when I'm just out personally with my wife and having a romantic dinner, let's say, and I would tip cash if I had it. Now, I'll be honest, I don't know how many people carry a lot of cash with them or carry cash with them on a daily basis, but hey, it goes out there. Hey, I want to say thank you for all the wonderful questions and everything that we've gotten in today. It's great to do a show like this and get questions and answers. I'll be honest, I was talking to one of my new clients here this morning and advising them because they didn't read the EIN letter, that when they set up their company, they were responsible for filing a partnership return. And it's been a number of years and everything. But I was talking about show prep and I went, I did absolutely no show prep today. And I had no idea what questions you guys would come up with. And you guys make me look good and ask some great questions. And I appreciate that. The one thing I want to say, tax laws and regulations, they're actually complex. Always. If you're running a business or you're making money or you're looking to start a business, have a good consultation with a qualified tax professional so that you can get good advice and good consulting prior to starting your business or even while you're running the business. When we talk here, this is broad-based. So this is going to apply in many different ways. It's kind of like talking about depreciation and other things out there. Depreciation is specific to your business and the way it should be done. They shouldn't necessarily take 100% depreciation or bonus depreciation when you're in a very, very low tax bracket. Could be a waste of a valuable deduction somewhere down the road. So keep these things in mind as you're going through and doing this. you're looking for planning opportunities. You're looking for ways of saving money and doing things the right way. I have seen so many people, CPAs, enrolled agents, you name it, out there preparing tax returns, and it's all about making themselves look good. I look better when I've planned with you as my client than when I come in and say, hey, buy this new tractor for $100,000 and let's save all your taxes. Do some tax planning, do some strategies. So you want to make sure that you're getting things done the right way. And, if you got more questions, put them in on wherever you're listening to, or if you hear this podcast, go to taxtalk4u.com. Listen to the podcast on iHeart, on our Facebook page, again, at taxtalk4u.com. Put your questions in. We'll come back and answer any questions we've missed next week's show. But you got to tune in here, 10 a.m. Eastern Time on W4CY Radio, taxtalk4u.com. Go over there, like, share, follow, but whatever you do, be here Mondays, 10 a.m. Eastern Time. Give us your questions. We'd love to hear you. Hey, have a God bless, glorious week. Enjoy this beautiful week, what God has given us here in the United States. God bless USA. God bless you. Be safe out there and have a glorious week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4u.com. See you next week at W4CY.com.